Hello and welcome to the lecture on credit. So let's talk a little bit about credit. You may have a general understanding about credit or you may know nothing about it, and that's okay. That's what this lecture is here to enlighten you on. So credit is the ability to borrow money with the promise of repayment at a later date. Typically, it will have interest tacked on, sometimes not, depending on the underwriting of the loan that you're receiving. So let's say you're going to go buy a vehicle. Typically there's going to be an interest rate associated with that unless you buy a vehicle that's maybe there's a special going on and there's no interest. Now you're going to have a set payment, and then if you have interest, it's going to be figured in with that total monthly payment. You can always pay more than your monthly payment, but you have a minimum payment that you must make every month until that vehicle is paid off. The same goes with the credit cards, but let's dive a little deeper. There are several examples of credit. For instance, credit cards. You may have a credit card already. You probably have a little bit of knowledge on the interest rate associated with that if you do. Loans. There's car loans, there's student loans, there's mortgage loans, there's personal loans, there's a wide variety. There's also store credit. Every time you go to TJ Maxx or Marshalls, they're trying to pitch, hey, get our credit card, you'll save 10% on this purchase and accumulate so many points. That's an example of store credit. And then BNPL is buy now, pay later. Klarna, Afterpay, you've probably seen them when you're checking out somewhere. This is where you're able to buy a service or a good and you agree to pay. Typically, it's like 4 to 6 installments. Sometimes they run a special of having 0% interest, but you can see on this graph that that goes upwards of 30%. So if you miss a payment and go beyond that 0% interest-free rate, you could be paying upwards of 30%. On credit cards, the same thing applies. You may have a 0% interest for your first 6 months or first year, but the average is between 15 and 25% interest rate. If you're not making that payment before the due date. So typically, credit cards companies let you pay a minimum payment, and that doesn't include interest. If you're making your payment every time it's due, you're usually not paying any type of interest. You're actually on some credit cards getting money back or cash back points, whatever. They're all different. It's kind of like an incentive for using the bank's money. But if you miss that payment or that due date, you're going to have interest, and it's typically between that amount. Now, car loans is between 4 to 9% unless you get a 0% interest rate. Student loans range between 5 and 12% because there's different types of loans. And then mortgage, of course, is between 3 to 7%, but it can be more. And then store credit is usually between 20 to 30% APR, but of course, if you make the payment before, it's typically no interest associated. Now, I want you to keep in mind that these interest rates here are for a person that has good credit. Now, if you abuse your credit, and we're going to discuss this as the lecture progresses, how this can negatively impact these rates here. You will be paying a vast amount more. The banks see you as irresponsible and they must tack on more interest because they are worried that they are not going to get their money. And you're more of a high risk. So they're going to tack more interest on because they are at much more of a risk of not getting their money back. So you're probably thinking, how are credit scores calculated? Well, I'm here to tell you there's a lot of math and science going on behind the scenes when these scores are being calculated. 30% of the score is figured on the amount owed. So how much are you using? How much are you spending on a credit card, student loans, everything figured in. 35% is your payment history. How often are you making the payment? Are you making the payment before it's due? Or are you making the payment after it's due? Everything is figured into this. 10% of new credit. Are you opening new lines of credit, or are you just keeping the same credit lines open that you've had open the whole time? 15% is the length of credit history. This is very important. Keeping a line of credit open is just as important as opening new credit lines. They want to see that you're able to maintain and keep a credit line open and the card's not getting closed or you're abusing it. And then 10% is credit mix. So this is a combination of having credit cards or student loans, a car loan, personal loan. They want to see that you're diversifying your level of loans or any type of thing that consists of credit. Maybe you're buying furniture from Ashley Furniture, you have an account with them, or you have a credit card. They want to see that you have different types of accounts. So this plays into how the credit score ranges work. So your poor range is between 300 to 579. Fair is 580 to 669. A good score is 670 to 739. A very good score is 740 to 799. And exceptional is between 800 and 850. Thankfully, 71% of Americans have what they call a good FICO score or better. Of course, this changes very often depending on how people are doing. But you want to stay at least in the good range. You do not want to fall in the poor or fair. That is when those interest rates are going to skyrocket and cost you so much money to be able to borrow money. And then at that point, it's not even worth borrowing money. You should just be spending the money that you have on hand and nothing else. So how do you establish credit? First, start with a secured credit card. A secured credit card requires a deposit that acts as your credit limit. Think of it as you're going to give the bank $4,000. That's actually your money, and when you run that card, that's actually you're spending it. Your money that you put in. So you're not really losing money. You're just allotting so much so you can show them that you're not going to blow through that $4,000 that you put aside in 2 days. You're just showing them that you're responsible, you've had this money, and you're going to use it like if you were borrowing their money. They want to see how you do before they offer you their money. Also, you can become an authorized user on someone's credit card. If your parents have good credit and they're willing to add you to the account, they don't even have to give you the card per se. They can give you the card, but they could just add you to the account, and the lending company is never going to know that you don't have that card. They're just going to see that your parents are making that payment every month. They're not abusing the credit line, and it's going to positively impact you. But please keep in mind that if your parents do not have good credit, or if they have had several credit companies put liens on the house or take cars back, repossession, do not do this to yourself. This will hurt you more than it will ever help you. So just don't do it. You can also take out a small loan with little to no interest rate. Maybe go buy a bed or a nightstand at Ashley Furniture and make the payment every month. And it could help you just as much as having a credit card. You want to also keep your credit utilization low. Do not max out your credit cards. Do not pull out more money than you need. Try to use it sparingly and smartly. So you're probably thinking, well, why do I need good credit? What's the point of having credit? So practically everything nowadays looks at your credit score. For instance, lower interest rates. If you're going to go and buy another car, go buy anything, they're going to look at that credit score and see how you've been doing with your credit, or if you even have credit before they'll offer you something with a good interest rate. Housing options. Nowadays, mortgage companies, of course, are looking at that, but rental properties as well. The landlord wants to know that you have made your payments on time. Are you a reliable tenant? All of this stuff plays a major part into if you're able to get quality housing. Also, insurance, car insurance. They look at your credit score. They want to see if you're making payments on the time because they want to know that they're going to get their money to be able to insure you. Also, believe it or not, job opportunities. Some jobs will run a credit background check on you to see how you're doing. This is very common for finance jobs. Because if you're managing their money, they want to know that you're managing your own money well. Because if you can't do your own, you definitely cannot do theirs. Because typically it's a lot more money that you're handling. Also, cell phone companies. I see this all the time. Cell phone companies will not offer people a plan or even let you finance a phone if you have no interest or if you have bad credit. Because they're taking a risk on giving you that new iPhone and you not ever pay the first payment on it. So you need to have good credit if you plan on having a cell phone, which I'm pretty sure everyone would like to have. Also, car rentals. Say you get in a car accident or you're going on a trip and you need to rent a car. They will not rent you a car if you have bad credit. And a matter of fact, if you don't have a credit card, they typically won't let you rent a car anyway. They do not like debit cards. They frown upon that. They would rather have a credit card because they know that there's some type of money on it. That they have a greater chance of getting their money if they are using a credit card to make payment or even place a credit card on the account. It's a much greater chance that they're going to get their money if there's a credit card there. So it is so crucial in today's society to have good credit and different types. And of course, this is my works cited. If you have any questions or need any help on understanding credit or working through this topic of the module, please reach out. But it is always smart to speak with a professional, possibly a CPA, or maybe a bank, and just talk to them about what you're wanting to do and how you're wanting to establish credit. And they can help point you in the right direction. That's what they're there for. And of course, I'm here to answer any questions.